China, Japan, and US jumped from going from $2 trillion economies to $5 trillion economies. That's when the majority of their bull run expansion happened. Their stock markets grew 7x, 10x, and even more at that point. And I think that's the stage that India is in. So I truly believe in the India opportunity, and that is what we're backing at SSP.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Shrishti Sahu with us. Shristi is a managing partner at Swadharma Source Ventures, SSV in short. She has led investments in 40 plus companies. Prior to starting SSV, Shristi built a fintech company, worked at a fund, and also headed startup programs for Facebook. In this episode, we talk about story of Shristi and Swadharma Source Ventures, upcoming mother of all bull runs in India, drawing parallels between private and public markets, how they source and win deals at SSV, perspective on Bharat, why family offices are a great source of patient capital for founders, why we need more men in the kitchen to bring more women in the workforce, and lots more. So without wasting any time, let's dive straight in. Hey Shristi, so good to have you on the VC 10X podcast. How are you doing?
I'm doing great, Prashant. Thanks for having me.
Yeah, it's a pleasure having you on. And to get things started, can we first have the background story behind Swadharma Source Ventures, SSV in short?
Great. I actually will go a little bit further than Swadharma. Actually, I
Sure.
have been in the ecosystem for over 13 years now, and started my journey as a founder myself. And prior to SSV, I was building a fintech company in the collections debt space. And after scaling that and exiting that is when got liquidity, and for the first time wanted to figure out from what the table looks like from the other side. And while the ecosystem was very nascent, I would say still there were, while VC funding was happening significantly, but I think it was more about the craziness that you see now in terms of how widespread it has become, and how deep it has become in terms of market that wasn't there. So as a founder, I first realized this as a pain point myself, where founders did not have access to VCs, or found VC to be very mystical, right? So after my founder's journey, my thing was to figure out, okay, can investing really work for me? And so that's where I started. I worked at a fund as well, and set up the family office. So set it up as a family office. Have done 45 investments in the last 7 years. I like to come in very early, given my founder background. So, like to work with founders in their 0 to 1 stages. Very often, we're the first check that is committed to founders in their rounds, and we help them form the rounds as well. So now it has grown significantly, but just wanted to share some more context in terms of the founder experience, because I think that has been what has worked in our favor as well. Having deep founder empathy and understanding what a founder goes through is not what a lot of investors can say they relate to, unfortunately, while that is changing a lot, but it wasn't true at that point. So that gives us a right to win in the market, and that's how we've been able to scale so far.
That's an amazing background, and having that founder experience is always a plus because you can have more empathy for founders. You know what the hustle looks like in reality. So that's awesome there. And now let's talk about what you're trying to build at SSV. And what's your particular? Do you have any particular thesis there, or you're investing across different? I've seen your portfolio. I've seen that you've invested across different sectors. So would love to know what's the thesis that you follow there.
Well, we are actually very deeply bullish on India. Let me start by saying that, I really believe that, as India grows from a 2 trillion economy to 5 trillion and even more in the next 5 years, what we are going to witness is actually, and I wrote about this, I termed it mother of all bull markets, because, and we've seen this internationally as well, when, China, Japan, and US jumped from going from $2 trillion economies to $5 trillion economies. That's when the majority of their bull run expansion happened. Their stock markets grew 7x, 10x, and even more at that point. And I think that that's the stage that India is in. So I truly believe in the India opportunity, and that is what we're backing at SSP. This family office is actually only, this private entity is only investing in companies which are either building for India or building from India. It could be for the world as well. We have bagged several global products. In terms of sectors, if you ask me, I think fintech, SaaS, consumer, and clean tech have primarily been the four sectors where we've been investing heavily. And if we go deeper into that space in terms of opportunities, the sectors that we're looking at are at the intersection of, the first one definitely is AI and software for us. Because the fundamental belief is that from being software led, everything's going to be AI led in the next 5 years. And how can you support that growth? And a lot of the products will be built in India for the world. So how do you back founders in that space and help them scale with their GTM and help them with global expansion, etc. Second, I would say clean tech. Clean tech is a big theme for us, not just in the EV and mobility space, but also companies that are focused on reducing carbon emissions. India has a big goal that it needs to fulfill in terms of reducing carbon emissions by 50% almost. So backing companies in that space is actually something that we've been doing. There's a company called Akashia.ai which we backed, and now it started in India. It's going global as well. Manufacturing is actually another theme for us, given that we believe in the China N+1 opportunity, where a lot of manufacturing from China and other countries is going to come to India. There are tremendous benefits in terms of regulatory support and policies to enable that. And I think the world has finally woken up to the power of Indian fintech. With UPI becoming so mainstream, not only in India but also across countries now. So financial services, definitely another core theme for us. I think, and given it was the sector where I previously built my company, I think there is a bias in that sense over there. So fintech is actually majority of our portfolio and continues to be, because if you look at the Indian public markets, most of the profit pools actually lie in the BFSI sector. And while the profit pools exist there, I think the market is ripe for opportunity in terms of fintechs, like fintech companies collaborating very deeply and closely with banks and NBFCs, which we'll be seeing more of in the next 2 to 3 years. And it's happening already. You can see how major companies who've raised significant funding either buying banks or becoming getting licenses themselves. So I would say broadly these are the four opportunities for us if we were to look at what we're investing in 2024 and right now as well.
Absolutely, that's amazing. And I've seen some of your posts about the public markets as well, and I believe you also have some experience operating in the public markets as well. So, how do you draw parallels, or maybe draw some connections from the public to the private market investing you're doing? You mentioned one case there, but is there more that other private investors can maybe draw from the public markets?
Yeah, absolutely. I feel public markets are the best teacher when it comes to figuring out how to become a good angel investor or even doing well at private market investing, because you get to understand how businesses work at a fundamental level, right? In terms of having deep understanding of unit economics, financials, where do the profit pools really lie? Because if you look at the top say 50 companies in India, you will realize that it's a no-brainer that fintech and consumption are some of the biggest themes, and manufacturing, so it's a no-brainer. So when you derive that or extrapolate that from the public markets and bring it to private markets, it's pretty much a validated thesis in terms of where the opportunity opportunities really lie. And while sure there'll be other category creators and companies which will come up which didn't exist before, but primarily, economic expansion is driven by certain sectors which have been established, and they're very legitimate profit pools in terms of cash rich companies. How are they doing it? So from that perspective, it's a great learning playground for anyone who wants to understand private markets better, to figure out how to do it, right? If to give you one example, as whenever we're doing the valuation exercise, right, in terms of how to value private companies, one exercise that we always end up doing is that, are there any public companies which can be compared to the private opportunity that we might have, and what are the multiples that those companies trade on? So to just to be able to understand, okay, so if a company's revenue is x and they're trading at, say, 20 times x, so how, so that gives you a basic multiple in terms of being able to understand how to value the private market investments. So I actually wrote about this just yesterday on Twitter, that having an equity markets background actually makes you better at analyzing private market opportunities. But the trick is to not get too attached to how you value those companies. I think that's the biggest takeaway that I've personally had. Because public markets came to I started investing in public markets much before I entered the private market. So I think that learning really helped me, and still helps me on a regular basis. But one thing to take away from that was that don't get too attached to how you value those companies, because those are very different businesses. Those businesses, in public markets, you're valuing them on the basis of what will not change, so you're actually betting on them to keep growing at a consistent rate, or you have some history attached to, okay, this is how the companies performed previously. In private markets, and especially at this stage that I operated at pre-seed and seed, you have nothing. A lot of the times, not even a year's long history when you're talking to founders. So it's a very different exercise altogether in terms of valuation, how to understand those businesses. Because in private markets, you're betting on how is this founder, or how is this team going to disrupt the market, right? So they're ultimately very different mindsets, but I think there's a lot to learn from each other when you're doing investing at large.
Absolutely. I completely love that approach to investing and how to use the public market, information or experience, if you have that, to guide your private markets investing, while also, knowing the difference between the two markets. These are not the same, but there can be useful information that can be used there. Uh, I'd love to understand, you're investing in these companies. So when you're investing in them, are you at that time, how are you basically evaluating them, on what all basis, market valuations, and is there a public company listed in the same sector? But also, these new startups are sometimes very different from the ones that are listed, right? Maybe
Yeah.
they're even operating in the same sector, but they're still very different, right? So we'd love to understand maybe how you do the analysis for that kind of a company, and what can be the potential exit pathways for that company.
Yeah, definitely. See, I'm like, while I'm saying that it's great to learn from those companies, the opportunity that exists in private markets is that, they are not like your public market companies, right? Those businesses were built over decades, whereas these private market investments will be built over 5-10 years, right? So, what you're betting on is, can they get to that scale in a shorter period of time by exponentially growing, right? I think that is the bet, and that's what people need to understand. So the first layer always is tech enabled, right? For the longest time, actually, I think manufacturing is something that we've only done this year, because of the India opportunity. But till this year, we hadn't done any non-tech businesses at large. And that the reason primarily there was that you're trying to go after the private market, public market scale and get to that at a very short speed. So the only way it can happen is through major technological advancement, right? And if you think about it, AI will be even will add multiple layers to that, even, right, in terms of speed, in terms of delivery. So the way to understand those businesses is very different at overall. But when you're looking at opportunities, is that, so for example, if you look at the public markets, you look at how large credit is, right? How what businesses are built around lending. So those things are not going to change, because at the core, you can give credit offline and you can give it online. How are you giving it? How is it getting to scale? I think that's what's important to understand. When we're looking at private markets, it's about understanding that, is it an exponential opportunity for us, and then, also understanding, is this the right team to be able to do it? Because a lot of the times, investors are not just betting on the founding team, they're not just betting on the market, but they're also betting on the fact that this will be the best team in this sector to build on this product, right? So you need to get all three right. It's not just getting one out of the three, because that combination doesn't work. So you're pretty much betting that, there won't be a better jockey will come along and win the game. Because a lot of the markets, while India is a large market and there is room for multiple winners to exist, most markets don't end up being a winner takes all markets, but there will be a fair bit of saturation that happens after two winners, right? So at max you can go wrong with coming in the second place, but you can't be lower than that, because that's how capitalism works, and it weeds out the weak ones. So unfortunately, you're in the game of being able to bet on the fittest, and at the very earliest stages, and you have to look for signals that you have to depend on to be able to choose which teams are the best in terms of backing them. Specifically when it comes to identifying founder qualities, right, or founding teams qualities, because we're very cognizant of the fact that large companies are not built just on the back of one founder. It's usually a good and very strong founding team that needs to come together. So we will definitely look at the quality of the founding team, and also look at what gives them the right to win in the market that they want to go after, right? So deep domain expertise is something that we look for. It can be, after years of working in that particular sector, or having spoken to several customers, so being able to understand and identify customer pain points very clearly. I think so. Deep domain expertise or insights is something that we look for. Second would be customer obsession. We love founders who are obsessed with their customers. So, knowing their customer inside out, if it's a delivery startup, knowing where, at what time would a customer want to place this order for a specific product, as granular as they can get. And those things are easy to figure out even in a few interactions, right? And the third thing, which is not as easy to assess, is resilience. Typically, when you're talking to founders, it's very hard to figure out, is this founder resilient enough, or is this team resilient enough to be able to ride through this bear phase, for example, that we went through, right? Like, who knew that, it would be so tough to raise funding in 2023 after the mad bull run that we'd had for 2 years hence. But you see that when the founders tested time and time again, and I think the best way to do it is to look at what they've done in the past. Do they have are they pursuing excellence? Are they in that frame of mind to really go after things and not give up? So, figuring out what kind of mindset do they operate with, and so getting to understand the founder really well. I think that's what's most important. So I think these three things, and obviously getting the market in your thesis right. So at SSV, actually, because of our approach, we kind of do a very thesis led investing, in terms of, we regularly talking to industry experts, and we're talking to people from the ecosystem, to be able to figure out where do the white spaces lie. And sometimes, we even go and look for founders building in that space. So it's not always, only inbound which is coming to us. We proactively look for founders building in certain spaces that might seem interesting to us as well.
Absolutely, that's very interesting, and that makes a good segue to the next question as well, which is about how you source and win deals. Because from what I'm seeing, you have some very interesting startups from across sectors within your portfolio, which includes Plum, which is, I believe, a B2B insurance startup, and then there is Chingari, which is a consumer app similar to TikTok, doing it for India, and then there is Stage, that is Netflix for India in regional languages. Then there is Growth School, cohort-based courses. There is Urban Yogi doing mental health and stuff, and then there is Ten Club, which is a collection of companies, a roll-up model, I believe. So, and many more companies. These are just a bunch that I'm mentioning here. So, we'd love to know how you came across some of these companies, and how and why you ended up investing in these.
Yeah, I think sourcing and winning deals happens, purely on the back of reputation, and reputation of how you've helped your portfolio companies, how did you treat them when things weren't going their way, for example, or even what kind of value add, as people like to throw it very loosely in the ecosystem these days, but what was the real value add that you brought to the table. And what gives us an edge pretty much, I think, is the founder background that we come with, because of the perspective of being able to understand that businesses are not built on Excel. You can do all the projections, and you can make it look very fancy on Excel, but operational realities are hard and very different from what you see on a deck, or even what the storytelling is the narrative that storytelling is trying to sell you. So I think winning and sourcing actually happens when people know that where founders choose you, because we also in this game, and I often joke about it, because investors sometimes get too into their heads and think that they're on top of the food chain, and I strongly disagree with that. And I've heard investors say this also, but like I really believe that without founders, investors don't exist, and capital is the easiest thing you can provide. It's not something that gives you an edge. So from that perspective, right, like how do you differentiate yourself? It's only on the back of how helpful you can really be to the founders, and that helps you win deals. So a lot of our investments right now come from referrals, actually, from existing portfolio founders who make introductions for us, because they've had a good experience of working with us, and they've seen that even if like other investors are turning against them, sometimes we are the supportive voice in the room. And that is something that founders never forget, right? Founders always remember who was with them at their lowest, and I think that's what helps us win overall. And also, I think in the VC space at large, it's we have to remember it's a people business, right? So being getting to speak to as many people as you can, just understanding what is the lay of the land. I am based out of NCR, for example, but go to Bangalore very often. So you need to spend time in different markets as well. Now increasingly spending more time in even tier 2, tier 3 cities, to be able to understand businesses that are being built for Bharat, so that you don't only invest in businesses which are in NCR and Bangalore, you even go widespread. So I think doing the work is very important as investors, and that's what we continue to do.
Yeah, that's really great to see. And I would love for you to differentiate between, maybe let's separate it into maybe three markets here, because you mentioned three. One is NCR region, one is Bangalore region, and then there is Bharat, right? Building for the tier two and tier three places. And you've invested in such companies. There is Stage there, which I see, which is making content for regional languages, and uh, I think Chingari also kind of serves more of that audience. So we'd love to understand how monetizable is that audience, and what kind of business opportunities are lucrative from that can actually produce a massive outcome, because there is often a perception that that audience is not willing to pay, right? So
Yeah.
what do you think?
I think famously it's said that, India is a Dow farm and not an Arku farm. So, from that perspective, I think we're still in the very early stages of being able to monetize on the Bharat audience, to answer your question. But we are seeing early signs of it, right? There are companies like, there are multiple companies which have scaled. Stage is doing phenomenally well. And they actually started from Haryana and then went to Rajasthan and other markets, right? So, they're proving that these companies can be built and people are willing to pay for it, and people are paying to even consume content, whereas everyone thought that no, and Indians won't pay to watch videos or pay for content, but like they are. And we're seeing that in different stages. There's another portfolio company of mine called Kutum, which is scaled to millions of users. They've got some of the best investors, and the founder, Abhishek, he's so customer obsessed and so driven. Like, from our very first chat, he was only talking about his obsession for like community based tools. So he would keep asking me which are the best communities that you were a part of, and what are the features that you like over there. So that level of customer understanding and obsession has to be there when you're building for Bharat. And I think propensity to pay will come. It's only a matter of time. We also have to remember that before 2016, India was a very different market. And after Geo is when, things really changed for India. And we're now at a point where, there are 700 million users who have access to smartphones in India. From a gaming and interactive media standpoint, also, we've crossed that point where, we need to prove that people won't pay for this market. I think we are seeing some of the largest spends happen in those markets as well on consumer apps. So from that perspective, I think things are shifting, maybe not as fast as we would like as investors, but things are changing dramatically. So 2016 to now has been a very different journey, and 24 to 2030 will be an absolutely different journey. And I think that's where the aspirational middle class, which will grow significantly and has the propensity to pay, will start paying for these products. So it's pretty much also the right time to build apps in the space. Although I must say that consumer is also the hardest sector, as an investor and both as a founder, because the outcomes can be extremely binary. There can be hundreds of companies in the space that don't work, and suddenly there'll be one which will emerge out as a winner. And it's usually very outlier and exceptional companies that are able to do that. So it takes a really long time to be able to understand markets. And most consumer companies can take a long time to be able to get to that one feature or two features where it can become truly scalable. For example, while I was at Meta, we knew that communities worked. Meta grew, or in short, like Facebook grew from their community groups approach. Everyone's been a part of Facebook groups, right? We've all looked for different things on Facebook groups or connected with different people on those groups. So, like, communities worked. And that's what, Kutum's insight was, that communities work for Bharat. It's just about figuring out how to make them pay, which is now happening as well. And then, for Stage as well, like, content works, but can people pay? So that is also being proven out now. I think we're about 2 to 3 years away from getting away from that narrative that, India won't pay for this, Bharat won't pay for the content, or even consumer apps.
Absolutely. That's great perspective there. And let's try to get the other side of you as well. So you've been in the space for quite some time, investing in the Indian market. You've seen startups that are doing good. You've seen startups that are maybe not doing so well. So what do you think has been the greatest challenge for founders and startups operating in India? And what are the things where we need to improve as an ecosystem in general?
Well, that's a great question, actually. I think, where one of the biggest things that I realized this year, and this is, after several pitches that happened where, I got on those calls and suddenly I saw that, it was almost like a Shark Tank pitch. Where, the founder came with a 2-3 minute pitch already rehearsed, and they thought, I can ask for 10%, take 10% of my company for this amount of money. But jokes aside, the biggest misunderstanding in the ecosystem, I think, has become that you need funding to be able to build a business. And that's where I'm realizing that even pre-seed founders and even businesses that might not ever need to have raised capital are sometimes falling in that trap that, oh, I'll raise funding now and then go build my startup. Whereas India has been so capital deprived for decades now. Most of the Indian businesses were built bootstrap. And I think that has become a problem, if you really ask me at this point, because not every business is a VC backable business, and I fundamentally believe not every business should be raising capital. But that's where I think with all this hype around funding and valuations and who's raised how much money and the unicorn tag, that's where we're being misled as an ecosystem, where we've completely moved away from that bootstrapped approach, that it's okay to not raise external capital, and it's okay to have like retain your ownership in the company and not dilute your ownership, because that's how businesses can also be built. So I think that has become something which I find problematic, that most a lot of founders who raise capital might not even be building VC backable businesses, and if they're not, then they shouldn't be raising funding, because what people don't understand is that getting announcing your funding is only where the work starts. Once you close your round is where the real work starts, because you are actually liable to investors, because you've raised money and you are responsible for that money. It's not an achievement to just go out and raise funding, because capital has become so democratized now that it's easily available in the ecosystem, so capital is not an issue. But if you raise capital for a business that might not be VC backable, that becomes an issue, because then you struggle to grow into that valuation, or even like find exit opportunities, etc. So that I think has become a little problematic, in my opinion.
Absolutely, I totally agree, and I think Shark Tank has done maybe some good things and some bad things for the ecosystem. And on the good side, I
And
think,
good things.
yeah,
Let me clarify that. And
yeah,
it actually boosted entrepreneurial spirit in the country
yeah,
like never before. So I will
yeah,
never take away from that. But people also need to understand that while there are multiple businesses that raise funding, not every business should be raising funding, and there are multiple ways to scale your business. Fundraising is not the only way. You can bootstrap it. You can get to a very decent scale and size without having to raise funding as well. So I think that's just a bit of problematic, with a problematic issue that I see. Yeah.
absolutely. And just so people know, actually, the episodes of Shark Tank are actually thoroughly edited. The pitches are actually not 2 minutes long.
Yeah.
They're pitching for, the founders are there and they're pitching for hours. There's grilling happening, and only a short clip is being included in the episode, because obviously it's a 1 hour episode, right? And even after that, what has actually happened is that even after Sharks committing capital that they're going to invest, some deals have fallen through later on. That a lot
Yeah.
of deals have not gone through still,
Actually,
despite
I
it being
think
announced.
60% of the deals didn't happen.
Yeah,
After.
something like that, something like that. So it's just what you see on TV, but the reality is kind of different. And investing actually works like that. It's not easy to raise capital, because investors are putting their money in there and they want to be thoroughly convinced that this is a good place to bet their money on. And you have to convince them. That's your job, and it can take time. It takes a lot of effort, but that's what this game is all about. And that's why you need to be completely sure that your business needs to take this path of being venture backable, and then you go forward and pitch VC, so, to save your time and save their time as well. Awesome. And one I think second last question before we go for the last one, and this one is about, uh, you're doing amazing in this space. You've backed some amazing startups, uh, and you're featured on multiple lists of the top women VCs in India, and that's incredible to see. And I want to ask you that, how do you get more women VCs from India or maybe across the world? Because that's something that we see across the world, that women are not as prevalent in the VC market or even the startup space, and even a fraction of the funding goes there. So how do we change that together?
Let me start by saying that, we have come a long way in the last 10 years. Earlier I would be the only woman on the cap table, and while sometimes that might still be the case, but, now I'm actually a part of multiple investor groups. Even there's one called Women in Investing that has over 400 women, right? So I would say that, times have really changed for India. But have they changed enough? I don't think so. There's so much work that needs to be done. I think, the biggest drop off that we continue seeing is, probably after marriage or having kids. And that is actually a very systemic problem, because unless women have support systems, they are not going to be able to work. And I don't think it's a problem of, women not feeling like they should work, or they don't want to work. It's also because, a lot of responsibilities at home lie on them, right? So if they do not have the room and time and space for them to be able to pursue their dreams, they will not be able to, right? So I don't think the motivation is an issue, or women need more empowerment. I don't think we need any of that. It's more about building support systems in society, enabling, after returning to work after kid programs, etc. Those kind of things really need to be looked at. Diversity across boards has been, institutionalized now in a big way. So just making sure that, as founders, if you're hiring teams, make sure that you have enough women in the room, right? And women bring a very unique perspective in both as investors and founders. So, and most of them end up being consumers as well, right? So like, if you don't have those people on your side, then you're not catering to that audience at large. And that is something that, every a person should be cognizant of. And I think it's more about building those support systems for them to be able to go and participate more in the workforce. And India hasn't been doing enough, in terms of having those support systems where, it actually helps them go out and be able to work, because a lot of domestic responsibilities ultimately lie on them. So it's actually a task of men. It's actually an ask for men to do better, and contribute more in terms of being able to support women in your life, so that they can pursue their dreams as well.
Absolutely, yeah, that's a great perspective there, and I think we have a segregation of responsibilities per se of what men would do and what women would do, and I think that's starting to blur, and that's I think that's what's causing this imbalance for the time being. I think long term we should figure out how we can like share our responsibility. I think we need more men in kitchen as well, and
Yeah.
that's also
Men are changing diapers, and men,
yeah,
taking care of their babies, and not
yeah,
calling it babysitting. It's called being a parent, because,
yeah,
funnily enough, like, I'm a mom to a 1 year old, right?
okay,
And, when I'm looking after my baby, it's just me being a mom, right? Because that's what I'm expected to do. But, like, if the dad is looking after the baby, it becomes about babysitting. But I'm like, no, it's also just parenting. Yeah, it's him being there as a parent and not babysitting, because babysitting is something you do with others' kids, right? So I think just having that acceptance of, like, being okay with men participating and contributing more, and not getting judged by external folks, or even women being able to go out and work, and not being asked that, how's your baby doing at home, or why are you not spending enough time with your baby. I think those are things that, as a society, there's a lot of judgment and stigma that we need to overcome and work on.
absolutely. So the focus needs to shift from why are not enough women are part of the workforce to why are not enough men part of the household chores, right?
Yeah,
Yeah.
absolutely.
Awesome, awesome. Now coming to my last main question before we move on to the rapid fire round, and this one is about portfolio construction. So, how do you think about portfolio construction? Do you keep a part of the fund as a reserve, or maybe follow on rounds? Basically, how do you think about all of that?
Yeah, I think because we're set up as a family office, it's primarily our capital. It's not external capital that we've raised. So we are very flexible in terms of ownership targets as well as reserves. Typically because we come in at very early stages, so pre-seed and seed, we end up with sub 10% ownership, and that works for us. But when we do see an opportunity break out in the portfolio, we also have room to go significantly deep. So we don't. I wouldn't say that we have 50% follow-ons or 60% for follow-ons. The If we do see outlier companies, then we are willing to go very deep in terms of following on and participating with them for longer term. In fact, the best way to invest, in my opinion, is to never want an exit until you get to IPO, and goes back into my obsession with public markets as well. But I actually don't want to exit until the founder asks me to. And that could be because of majority reasons, other investors coming in, etc. But when we're partnering with founders, we are actually telling them that we're long term partners. We are very patient capital. Coming from a family business background myself, we know that generational companies are built over decades, and once you're building them, you need long term partners as well. So we're okay to partner with founders for the long term. We're not doing this for 2, 5, 10 years even. So we're in it for the long run.
Absolutely, and I had Ritesh Malik on the podcast, who's the founder of Innovate, who exited to OYO, right? And he also runs his family office, and he also had a similar perspective that okay, I'm not looking for exit. Whatever comes out of it comes out of it, right? Uh,
Yeah.
and he went
I
on to say, yeah,
we because we think that this capital is written off, and if it works.
exactly. That's what he said. Yeah,
Oh, okay. I didn't know he said that. But if
yeah,
an
yeah.
opportunity works out, then it's a big plus. But from the perspective of family offices, I think India is finally waking up to the opportunity that even family offices bring. I think 2023 was the year where we saw maximum participation from a family offices perspective, and this will grow significantly because there are multiple family offices in the range of, like, say, 50 to 100 million, who want to invest in private markets, and they're figuring out ways. Either they're becoming LPs in funds or doing direct investing as well. 2024 and onwards, I think, will be the time where family offices will participate very proactively. And if public markets have shown us anything, is that the domestic capital and appetite has grown so significantly in India, that even when foreign investors are pulling out money from India, there's more than enough capital in the domestic market to be able to hold the market and, like, even take it ahead. And we saw that several times in 2022 and 3 as well. And I think that's what we'll see in private markets also now going forward.
Absolutely, and that also is a point for founders to derive here, is that family offices can be a good target for you if you're looking for patient capital, right? Because VCs after a point of time, maybe 7 8 years down the line, can ask you for a return, maybe push you in that direction. But I think family offices are more patient because it's more of their capital, and they don't need to give it back to someone, because VCs have their own LPs that they need to return the capital to. So the family offices should be on the radar, because as we can see right here, that Shrishti is directly investing into startups, her being a family office. So definitely
If I
founders.
can just add there, Prashant, I think,
Yeah,
one thing that founders also need to keep in mind is that, when we're investing from the family office, in case things are not going in your favor, we will not be the ones telling you that, you should, we won't be the ones deprioritizing you in the portfolio, right? And that cannot be said for VC funds, because, as soon as they realize that, you are not going to be their fund returner, they kind of move on to the next opportunities, right? And that's what they are doing. They're trying to find their fund returners in every company that they're investing in. Whereas, from the family office perspective, we're actually investing in business builders, and we want multiple companies to succeed, not just one or two companies to succeed. So that it's a very different approach altogether. Even in terms of portfolio construction, we're not looking for just one or two portfolio outliers, but obviously power law will do the work that it has to. But like we're looking for multiple companies to work out and be successful businesses.
Absolutely. That's amazing. All right, let's do the rapid fire round now, wherein I'll ask you five quick questions about the investing that you're doing, and you have to give five quick answers. Sounds good.
Yeah, sure, let's do it.
Awesome. So the first one goes, what are the sectors and regions you invest in?
Yeah, so I think India continues to be one of our focus markets. We've done US investments as well. And AI and software, like I mentioned, clean tech, fintech, consumer tend to be the themes.
Awesome. And what's the typical stage where you come in?
Pre seed and seed,
Okay. And what's the typical check size you put in?
100 to 150K USD.
Okay. Where can founders apply for funding in case there's a direct way?
Yeah, I'm actually very accessible on LinkedIn, Twitter, etc. We have a fund website also. So pitch at ssv.fund works great, but I'm happy to share my email as well directly for the listeners. So at ssv.fund is a way to reach me directly.
Awesome. And last one, where can listeners go and follow you?
LinkedIn, Twitter, are both good platforms. I think I also write. I love writing on what's happening in the ecosystem and also sharing my learnings with people. So I have a Substack for that. So if anyone's interested in long form content, they can follow my work there. But yeah, LinkedIn, Twitter work great.
Absolutely. That's awesome. I'll make sure to put all those links there in the show notes. Thanks so much for coming on, Shrishti, and sharing your insights on the Indian ecosystem. Thank you.
Thanks, Prashant, for having me, and kudos to you for doing this for the ecosystem.
Thank you. My pleasure.